Welcome back. Joining us on the show now is Derek MacPherson from West Point Gold. Derek, hi. Thank you so much for joining in. First of all, what is your sense onto the gold prices? They have declined overnight as investors await U.S. Federal Reserve minutes. To discuss more, what's your sense? What is the macro that you're looking at?
Well, I think it's higher from here. I think that we got into a little bit of an overbought territory. I think it got a little overcooked, and we've had a pullback from there with risk appetites changing a bit. But I think the underlying fundamentals that drove gold price higher in 2025 still exist in 2026. You have central banks diversifying away from U.S. dollars. You have governments spending aggressively, so you have increased liquidity. And so I think all those things still apply. We've just had a little bit of pause in the run higher.
When you say the gold prices are going higher from here, Derek, what is the price range that you're looking at?
Yeah, I mean, I think that 6,000 is entirely possible. I don't like putting a time frame on it though, and I think probably even higher is possible over the next couple of years. Simply because you've got your traditional bull markets in precious metals would point to something closer to $8,000 for the gold price peaking out at. Whether it comes to that or not, and exactly how long that takes to get there, but I definitely think that over sort of the medium to long term, there's much higher. The gold price could go much higher from here.
Derek, with the global macro shifts impacting precious metals, how would you look at the current interplay between central bank gold buying, interest rate trajectories, and how are they shaping out the miners' valuations?
Yeah, that's a good point. I think that the central bank buying is going to continue to push the underlying commodity up, which should be good for the valuations for miners. One thing that we saw though through 2025 and even into early 2026 is miners didn't really get expensive. While their cash flows expanded and their share prices expanded because of that, the multiples didn't really expand. And so there hasn't, we're still kind of ahead of the curve as far as kind of generalist demand into precious metals equities. And so I think that there's still room for those to run, particularly if you get any kind of multiple expansion. But as we look out, you look kind of global macro and how that all fits in. I think that part of what happened sort of in late February, early March was with the Strait of Hormuz was that you had a risk off trade, and so equities are part of that risk basket, whether they're precious metals or otherwise. And we saw sort of a pullback and a reset of risk across the board. And I think that. And I think we saw something similar to gold price, somewhere where people had a lot of investors had profits, they were able to take profits there. And so I think with that sort of pullback and that risk reset behind us, I guess, for lack of a better description, I think the peace deal or the tentative or the tenuous peace deal that we have in the Strait of Hormuz right now has allowed a bit of a move for risk on, a little more risk on. And I think that's what's benefited sort of liquidity and then also the gold price.
All right, that point is well taken. I would also want to understand on what really are the exploration milestones that West Point Gold is putting out for itself right now.
Yeah, so for West Point Gold, we're in the process of defining our maiden resource. And so our objective is to put out a significant maiden resource in line with our exploration target. Our exploration target is about 20 to 30 million tons at 2 to 3 grams a ton gold. It's about 1 to 3 million ounces. And so our effort right now is on getting the last of our drill results in and then pushing those and compiling those into a maiden resource that we can put out to the market. And that will really allow investors to value the company appropriately.
Derek, we understand that the exploration and drilling are highly capital intensive. What would you say is your financial strategy weaving into this?
That's a great point. We are a pre-revenue business. And so our one of the things that we did very wisely is that we raised money in January when the markets were a little more frothy and there was a lot, there was more capital available for exploration stage companies. And so we put ourselves in a really good financial position. So we're funded for the next 12 to 18 months. And so that has allowed us to sort of focus on the fundamentals of the company. our expectation is that the market will be there for us if we continue to have success with the drill bit. And so we think the company is fundable, particularly post-resource.
Gold has shown strong resilience amid geopolitical tensions. How is then West Point Gold positioning itself to capture this premium? And does the macro climate accelerate your development timeline?
Yeah, I think that, West Point is sort of the maybe I'll frame this answer another way. Where we are in the cycle is we're sort of still, sort of early in the cycle overall for gold companies. In reality, the majors just had really just started to move, and we just saw some developers move as well. The big gold companies all have significant cash balances. We've just started to see M&A pick up a little bit. And so I think we're early in the M&A cycle and early in the gold cycle overall. And so I think there's more acquisitions to take place. I think with West Point in particular, while we're probably not one of the first companies that gets taken out simply because we're a little bit less developed than some of the other companies that are out there, I think if we can get through the main resource and then potentially onto an economic study, I think that will change how other companies look at us. I think an important point for us and how we're sort of positioned to capture is that we have good fundamental catalysts. And so while the $4,000 gold price is just over $4,000 gold price is really good for us and where we think the economics of our project will eventually land, what we're not relying on the gold price move to actually to move the company ahead. We have because we're well funded, we're able to put out good, strong fundamental catalysts that advance the company and de-risk the project for our shareholders.
No, absolutely, Derek. You bet $4,000 an ounce is good for you because the cost of gold production is $1,200 to $1,500 an ounce. So $4,000 an ounce is pretty good, neat cash inflow for the miners there. But with the cost of gold where it is, would you say that the absolutely minimal hedging that the gold miners are doing right now?
Hedging is challenging, right? Because investors look for buy gold companies for leverage to the gold price. And so that's certainly something that is when you're hedging. I think that, if you're looking at hedging, the only time that you would hedge is if you have debt that you need to protect the downside on. And so, I think that there are companies that are kind of late stage build that still have some hedges in place or have just built and have some hedges in place. But generally speaking, I think the objective is generally to be unhedged.
Point taken. Derek, thank you so much for joining us here at CNBC TV 18. So the gold prices are going higher from here. And as far as M&A, gold cycle, hedging, all of that is concerned, well, all of that seems to be turning quite well for gold mining companies at least.
For over 25 years, CNBC TV 18 has been the guiding force for investors, steering them through the markets.
Start your trading day with cutting-edge insights and expert analysis.
Seize every opportunity by decoding the forces that drive the market.
Equip yourself with strategies and guidance from India's biggest market mavens.
Invest with confidence as we beam live from the CNBC TV 18 Motilal Oswal studio.